Hi and welcome to On the Record, your playbook for Tapping India. Today we are going to have a compliance walkthrough for your Indian subsidiary. So if you have an Indian subsidiary, what are the major compliances that you should be aware of and how to go about it? First and foremost, do you have an Indian subsidiary which is a cost center or a profit center? A cost center is majorly like if you are here in India just to tap the talent who is working for the parent entity, all the IPs is being developed, research and development kind of activities, software development, support. So there is no billing happening from India entity to anywhere else. All the expenses are put and handled by the parent organization. So that's broadly the definition of a cost center. A profit center is a scenario where you have customers either in India or across the world for which you are billing from India as well and getting that money to India as revenues. So that's where the profit center comes. So now let's look at what are those compliances that you should be aware of. If you are a private limited company or an LLP, then you would fall under the company's law. In company law, there are multiple things defined. For example, what is the frequency of doing board meetings? What are the various secretarial records to be kept? What are the audit requirements? What is the bookkeeping or accounting standards that you have to follow? So it is important to have some understanding of what the company law says and if you are complying to all of them or not. Since you are a global company, you have a subsidiary in India, the capital that you invested is treated as a foreign direct investment. So you also fall under something called FEMA laws, which is governed by RBI, which is Reserve Bank of India. So it's important to comply with all the requirements of FEMA laws, and it is not a one-time requirement. Every time a new capital infusion is done, you have to do certain compliances, and on an annual basis also you will have to do certain compliances. So you should be aware of the FEMA laws. Then let's look at some of the audit requirements. So private limited companies are subjected to statutory audit or a tax audit, what we call. Again, there are revenues, numbers defined, there are limits. So statutory audit is mandatory in each case. Tax audit could be applicable whenever you cross a certain number of turnover. A tax audit is a little more detailed way of doing audit where you look at larger set of transactions. Another compliance that you should be aware of if you are specially into software export, that means if you have a company in India which is doing software exports, a software export is you have a team in India which is developing IP for you or developing software for you, then there is something called Softex form. You have to register with STPI, which is the Software Technology Parks of India, and you have to do compliances. These compliances again is like every year you have to renew the registration and you have to do monthly or quarterly compliance depending on which bracket you fall into. It's an important compliance. Technically, if you are not doing this, you would not be able to bring money to India as revenues for software exports. It's not very closely monitored as of today. So take a call. If you want to be completely clean and compliant, then Softex is also the way to go. But we see a lot of people not doing this. So you have to again consult expert advisors to see what is the best way for you to take this forward. Now let's talk about some of the taxes. So there are two major ways which India has the tax structure. One is called direct taxes. A direct tax is the income tax that you end up paying or the corporate tax you can say. So any profits that you get in India has to be taxed in India and the taxes has to be paid here. So that is part of the direct tax or the income tax. In income tax again you will hear words like advance tax, which is more like you have to keep paying your income tax every quarter in advance based on the projected revenues or projected tax numbers for the current financial year. It is also important for me to highlight the concept of transfer pricing. So since you have a parent subsidiary relationship, all the services rendered from India is subject to transfer pricing. That means you need to keep a markup on all the costs that you end up doing, and it is not just about the salary cost, it includes the cost of depreciation of all the assets, the rental cost, internet, electricity, travel, compliance, every cost put together, whatever is your landed cost, there should be a markup. So technically India entity can never be into loss. That markup will be there, and every month there is a transfer pricing study done, again mandatory at a certain revenue level, and based on that study, whatever is the recommended markup percentage that comes for your industry and domain, you have to keep charging the parent entity at that markup, bring that money, pay taxes on it, and then you'd still be left with some additional cash. So that would continue to accumulate at India, and you can use that cash only for capex purposes, not for opex purpose, because as soon as you do any opex expense, it again goes back into the calculation of transfer pricing and you have to do the markup on that again. Then let's talk about the indirect tax. Indirect tax is now in India most popular is the GST, goods and services tax. So this is based on the revenues irrespective of whether you are making a profit or not. So anytime a service or a good changes hand, GST is applicable. Currently the export of services and goods are exempted from GST in majority of the case. You still need to register with GST. And there is something called letter of undertaking for exports, in which if you give a letter of undertaking, you need not apply GST. You can just invoice the parent entity without any GST and continue to file the GST returns on a monthly basis and say how much exports you have been doing. If you haven't taken an LUT or letter of undertaking, then ideally the rules specifies that you have to collect GST from the foreign entity and then you have to pay that tax to the government. And again, if you are export oriented, then you can claim a refund of that money from the government. There is a process to claim refund of GST. You should follow that and you can get a refund of GST. So it is best we recommend if you are like a parent subsidiary relationship having 100% export of services just to the parent. It is good to take that letter of undertaking so that you don't have to collect the GST. But all the requirements around filing of GST returns remains the same. It does not absolve you from there. It's just that collection of GST, payment to government and then claiming a refund can be avoided. Now let's look at some of the other license. So there is something called import export code. This is more like a driving license. If you have a license, then only you can drive on road. So if you want to engage in any of the import activities or export activities, you should have this registration from DGFT, which is called import export code. Without this license, your bankers would not allow you to receive foreign exchange or money in foreign exchange or to make any import payments outside of the country. Now let's look at some of the labor laws that is applicable in general. Again, there could be advanced compliances that would be needed depending on what kind of business you are planning to do and what kind of geography you are doing. There could be state laws, there could be central laws that could get triggered. So it's best to check in detail about this. We'll be covering some of the generic laws which typically we see is applicable on most of the companies that is doing business in India. First is the professional tax. It's not a tax, it's actually like any professional who is working in a state. They have defined certain limits, so you have to keep paying those tax. The amount varies from state to state. Then comes provident fund, which is more like a 401k where people contribute so that they can withdraw or use this contribution post retirement. Provident fund is contributed both by the employer and employee in equal proportion. So you can choose to have minimum provident fund deposited beyond a certain salary level, which is typically 15,000 a month, or you can choose to do it at a percentage of your basic salary, which is close to about 12% of the basic salary is what you can choose to contribute. Whatever the employee chooses, the employer will also do a matching amount of contribution to the provident fund. Typically, the cost of provident fund is nowadays factored into something called CTC. So when companies generally roll out offer letters, they show the complete cost to company. So in which both the contribution level of employee or the employer gets adjusted. So it's not truly an additional cost, but yes, it is very important to follow this. Provident fund generally gets applicable when you are 20 plus people. The next is the employee state insurance or ESI. It is mandatory once you cross 10 people set up in India. Before that, it is not mandatory. For people who are getting a salary of less than 15,000 a month, it is mandatory to contribute for ESI benefits. For people, if you have a workforce like everybody is having 15,000 plus salary, then you may choose to have your own private medical insurance, but you still need to take the ESI registration and do all the filings with a kind of a nil filing there if you have all the employees above 15,000 rupees. Then there is Shop and Establishment Act. Again, it's a registration with the municipal bodies. Depends on state to state. So you'll have to do those compliances and file an annual return. Majorly places it is an annual return, but the frequency could be different again state to state. Now let's look at something called POSH, which is prevention of sexual harassment. Again, this is applicable when you cross mandatory 10 people. And please note that this is mandatory for 10 plus people. Even if you have all the 10 male members or all the 10 female members, you don't need to have a mix of male and female, then only is applicable. So POSH is more about sensitizing the employees, training them about how to identify incidences of POSH, and then you should have a POSH committee formed. Again, there has to be an external member in the POSH committee and a few internal members, including one lady member has to be there in the POSH committee. You have to set up systems and processes where employee can anonymously report, or there is utmost confidentiality mentioned for any POSH complaints. In case if there is a POSH complaint that comes, the POSH committee should take up the investigation in utmost confidence. There are again standards and rules defined how to take it up. This is viewed very seriously. So it is important to sensitize all your employee workforce. It is important to display posters and stuff to remind them how to go about it, how to report the incidences. You should have a POSH system and reporting. And there is a periodic sensitization of both the employees, the POSH committee members, the founders, everything goes up. So those training programs are important to do. And then there are filings every year that you have to report what all activities has been done. There are specified formats. So POSH compliances is very critical. If you have 10 plus people, either all male, all female, or a mix of both, or any other gender, please note that more than 10 people POSH is applicable. Now let's look at what are the other things that goes into maintaining a subsidiary operation in India. First and foremost is the bookkeeping. So you should have a proper accounting system. You should follow the accounting standards prescribed by whatever laws like company law and stuff, so that you can continue to do the bookkeeping properly. Also, if you have employees in India, you should have a payroll system where you can run payroll month on month and comply with all requirements of running a payroll. For example, withholding taxes, filing for professional tax, PF, ESI and all these related labor licenses. It's recommended that you have a compliance calendar in place where you can keep a track of what are the various compliances that is applicable to your business, what are the frequency of each compliance in which you have to keep complying with various return filings or payment of taxes, payment of other fees and provident fund, ESI and all those things. You should also try to have a system where you can continue to monitor various compliances, and compliances in India keeps changing and they are ever evolving. So it's important for you to be on top of all these changes so that you are not non-compliant at any point of time. Now, if you have a parent subsidiary set up here, most of the time your home country may also require that all the books of accounts of your subsidiary. So for example, here in India, so Indian subsidiary, not just India, across the globe, if you have multiple subsidiaries, all the books and accounts has to be consolidated at parent level. Now the difference is every country may follow a different fiscal year. For example, US follows the calendar year as the financial year. In India, we follow April to March as the financial year. So when you do the consolidation, say for example, you are a US company having an India subsidiary, then you typically do it from January to December. Whatever is the activities that has to be consolidated and reported to US. Whereas in India, you would be reporting for the subsidiary for April to March. So it's important that you do some amount of finalization of accounts, freeze the books around November time frame, so that by December you would be able to share all the data, or post December, and then consolidate it at US level and then file your US taxes and returns. You should also be aware about various liabilities and penalties that various compliances bring. In case if you are non-compliant, it is good to know what kind of compliance penalties can be levied. If there is a delay in payment, there are interest which again varies from compliance to compliance. So it is good to know about this, and also what are the liabilities. So for example, few non-compliances in company law could be like worth few lakhs of rupees for every non-compliance incident. There could be smaller penalties, there could be very large penalties. So you should be aware of all this. Otherwise, there are high chance that you may end up paying a huge bills in interest and penalties there. It's also a good practice to have audit done on a regular basis so that you know that you are compliant and there are no compliance gaps. In case if you identify any compliance gaps, it is important to take proactive actions and close those compliance gaps rather than waiting for a government agency to come point it out, because at that time the penalties and interest could be much more higher. So it is always important to take a proactive approach to this. That's it. I hope this helps you to understand some of the compliances that is applicable in India and helps you to be a much more compliant company. Always important to have an expert advice and work with them rather than doing things yourself. It is a complex nation. Let's not make it complex for you and have a great experience.